Welcome to the Self Storage Show, where I have conversations with my industry friends, talk with owners and vendors, and share tales about my management company, 3 Mile Storage. Let's go. Hi, everyone. It's Jim Ross with the Self Storage Show. Got another episode coming at you here, and someone I've met for the first time, but we talked briefly. I'm like, all right, I got to get you on the show. So this is great. So I have to read this, so bear with me for a second. Got David Perlleshi with me. He's the Senior Director with the self-storage investment and sales with Franklin Street. Did I get all that right?
You did. Jim, really appreciate your time. Thanks for having me on the show.
Yeah, of course. I mean, that's just me blubbering on for a second. Can you give us just a little cliff note version of who you are and what you do, and we'll get into it here.
Yeah, absolutely. So myself and my partner run self-storage investment sales over at Franklin Street. We specialize in selling self-storage properties, boat and RV properties, and land that is zoned for self-storage development nationally. Prior to doing brokerage, I was in a few different roles. I was with a fully integrated multifamily investment firm based out of Tampa, Florida, that invested in 100 to 400 unit multifamily complexes. So over there, did a lot of the construction management, the value add opportunities, and oversaw a lot of the value add implementation of those deals over there. Quickly after that, started with another investment firm. It was a small family office based out of New York City. We specialized in buying value add opportunities for self-storage properties in the Carolinas. So during my short 3-year run there, we bought and developed about 13 properties, all of which had an existing 20 to 30,000 square feet of storage that was currently being operated and managed, mostly mom and pop. And we went in there and essentially doubled the size or tripled the size of those facilities by adding climatized self-storage units, and just kind of like getting them up to institutional quality deals. So quickly after that, jumped into investment brokerage sales, specializing in self-storage. And really, we just had a lot of relationships on the self-storage side from 2016 on, and we decided to really kind of monetize those relationships. And we felt as though a lot of different brokers in the business, in the sector, didn't really understand the investment side of the business. So we really wanted to kind of loop ourselves in, knowing the investment side, knowing what a lot of buyers are looking for, because we were on that side as well.
Yeah.
And we're still partners in a lot of those deals in Western North Carolina. And my partner and I also bought a smaller facility outside of Pensacola just about a year ago. So we'd like to pride ourselves not only doing brokerage, and that's our day-to-day job as far as self-storage sales, but we're also owners in the space, and we understand a lot of difficulties owners run into from the management side, and just the rising expenses with insurance going up and all that jazz. So we experience a lot of the same struggles a lot of owners do as well.
I bet. That's why I wanted you on, because again, you have a much more well-rounded approach being the broker and an owner and that. So I was like, all right, got to get you on. Did you say you have a site in Pensacola?
We do.
I got to ask, were you able to get insurance? I heard it's insane getting insurance down there right now. Everyone's getting like denied and like, oh.
Luckily we did.
They did? All right, cool.
Insurance premium went up about 50% from last year. So definitely hurt the bottom line a little bit, but we complained, but it didn't do much. But
I know some sites that were being built down there, and just because of the insurance going up so much, it blew it out of the water. Like it didn't work anymore just because of that one factor. Like
I'm sure. I mean, that's a lot. That's another thing. I mean, Jim, we can kind of get into as well. But a lot of these coastal cities are experiencing a lot of the same things. We were very fortunate, and quite frankly, we were happy just with a 50% premium, because we're hearing from a lot of clients of ours where they're getting, their premiums are doubling or tripling,
yes.
depending on what coastal cities they're in, especially if it's a coastal city of Florida that's experienced some type of hurricane in the last 3 to 4 years. We're hearing a lot of that happening, and a lot of the folks that we're talking to here at Franklin Street who specialize in property insurance, they're describing the industry as in crisis right now. with what's happening as far as insurance, because of just the premiums across the board are going up at a minimum of 50%, sometimes, like I said, 200 to 300%, depending on where they're at.
Okay. I manage some sites on the coastal of North Carolina, and it's a lot of those hurricanes are going up that way now too. So I'm just waiting for us to be next for that kind of stuff. I'm like, no. Anyway, so that's why I wanted to have you on, because you have a great, well-rounded approach. So jumping into it here, I mean, what are you kind of seeing as far as the market conditions, kind of on the broker side here?
Yeah. So we're seeing a lot right now. There have been better times for sure for brokers. 12, 16, 18 months ago were great times for us. Now it's a little bit tougher to get deals done. Internally we joke around a little bit, trying to get deals done. It feels like we're dragging bodies across the finish line. Where last year, deals were getting done, 45-day close, 60-day close, and they were getting done, seamlessly.
Yeah.
So it's a little bit tougher out there. I mean, the biggest issue we're seeing is the lending. Lenders have really tightened up as far as what types of deals they're willing to lend on. So that's been a little bit difficult for a lot of buyers to kind of wrap their heads around how to buy these deals. A lot of sellers the expectations as far as pricing are still at 12 to 18 month ago values, which just doesn't make sense.
That's not realistic. Yeah.
Yeah, and it's not. We have a lot of these conversations with our clients on a day-to-day basis. We're just like, hey, where things were a year plus ago is not where things are at now. And the reason being is that interest rates were around 3 to 4%. Now we're looking at interest rates hovering around 7 to 8%. A lot of lenders were willing to underwrite deals and lend on deals that had heavy value add component, that had some type of lease up component, that had deals that were being delivered vacant on CO or certificate of occupancy. Now a lot of those lenders don't want anything to do with those deals. They want really cash flowing assets that are performing well and that have historical occupancy that's been at 90% or above for the last 3 years. They want to see strong cash flow over the last 3 years. They don't want to see anything that's a little bit risky in their minds. So I would say that's the biggest catalyst as far as why deals have really suffered as far as the valuations, and why the industry has really slowed down as far as volume and transactions.
Interesting. They want to see a proven track record. They want to see that history, because
Absolutely.
I don't know how many people were that was their whole deal. They would get the land, build it, flip it before they even rented a unit. I mean, it was just like, blows my mind, because I'm so much of the operations kind of guy. I'm like, no, let's start. We haven't even started yet. What are you doing? But it's crazy. I get it as an investor, like, hey, let's just flip it, but that's dried up now. So
that's precisely, that's exactly what was happening. And it was interesting because at that time, the way that we were underwriting deals and we were valuing them was basically on pro forma, based on like the future performance of the deals. And a lot of these deals were trading at pro forma values, or essentially at future values after the value add plan was implemented. Because that's how aggressive it got in the market, and that's what buyers are willing to do because of how cheap debt was at that time, and really how cheap equity was at the time as well. There was a lot of equity in the market. There was a lot of investors in the market at that time. So when that was happening, it was really difficult to explain to realistic buyers that were out there trying to buy their first or second facility, or trying to add on to their portfolio, and they've been in the industry for call it 10 plus years, where for them it just didn't make much sense. And trying to sell a deal vacant based on what it's going to be valued at in 2 or 3 years from now when it's actually occupied is a really hard sell. But those deals were getting done then, but now they're not getting done.
Interesting. Okay. I know some guys are going to be crying about that, but yeah, their whole investment strategy went out the window. That's how it goes. So I'm curious now, kind of on the owner's side of things, you got to be feeling it, right? Like the oversupply, are you kind of feeling the pinch in certain areas?
Yeah, absolutely. We're feeling in our facility right now. We've had a drop in about 15% occupancy. We were at 99%. Now we're hovering right on 85% in our facility. Also, some of our other facilities in Western North Carolina, we have seen probably anywhere between a 5 to 7% drop in occupancy. That is due to a lot of like oversupply being delivered. During COVID, we kind of had this standstill of construction from the lending side, contractors, just a multitude of factors. What now has happened and transpired is you've seen over the course of the last year a lot of the supply that was either in permitting or planning or in construction during COVID now being delivered to the market. And a lot of the existing owners, where it's small or mid-size owners in these areas, have really run into a lot of issues with occupancy. One thing that we're doing and we're seeing with the REITs, we're seeing with the mid-size operators, is really doing your market surveys, really going out there and understanding what the rates are being charged, what rents are being charged in the market, understanding what your closest comp is doing, your comps that are 3 to 5 miles out are doing, and really understanding where rates are, because rates aren't what they were in most markets a year ago or even 2 years ago, and getting really competitive. I mean, we're seeing with the mid-size operators and the REITs, they're essentially slashing rates in half. So if you're operating your facility and you're humming along at 90% and you have some big players in your market, and they're offering half the rate or half the rents that you're offering, chances are they're going to probably get those renters and you're not, and that's going to hurt you on the occupancy side. And I think what we're seeing is, with this dip in occupancy, and these dip in rates, we're seeing the REITs and the mid-sized operators race to whoever can drop the rates the lowest. And by doing that, they're trying to capture occupancy. They're trying to keep occupancy up artificially. But by doing that, they're hoping that in 6 to 9 or 12 months from now, they can probably get those rates back up. And that'll kind of save the cash flow of the property. But, for any owner operators out there that are holding steady and seeing the move outs, seeing the occupancy drop, I'd really encourage them to go out there and really understand where market rates are at right now, and having to kind of compete with those groups and hover around the same pricing as them.
Yeah, I have that question. It's almost going to be like on a daily basis now with owners and that are, because you can't control the move outs. People are going to move out when they're going to move out. I don't care what you're talking about raising rates. It's just when they move out, that's pretty much a reliable cadence. But it's the move-ins, like you're saying, that's really getting hit.
Yeah.
And it's, in fact, I'm filming an episode featured with a guy we're talking about. It's a race to the bottom, and that's what it is. It's a race to the bottom of just being like, we're the cheapest, we're the lowest, come in for the flash sale. But what the customer doesn't know, but what you and I both know, that 3 months later they're boosting them like $80 for a rent raise, is trying to get that price back up to where they need to be.
Exactly.
It's going to be interesting to watch, see how that plays out. I mean, these guys have they have the data and all that to try to mess with these numbers and see what's going to work, what kind of move-in special. But in the meantime, the smaller operators, it hurts, because I look at those numbers and like, I don't want to sit there and be like, hey, $40 for a 10 by 10, which I was, $110 or something like that 2 months ago. I'm like, that's a hard pill to swallow. So it's going to be interesting to see what kind of plays out when it comes to that kind of pricing strategy. But in the meantime, yeah, know your market, because you don't want to be too far down the road and looking back on 6 months later going, oh, I could have, should have, would have known this a little while ago and changed your pricing strategy. So yeah.
No, we've seen a lot of that. Primarily where we've seen that happening in Jim has been your core markets, or call it your primary or secondary market.
Yeah.
We've seen a lot of that. On the other side, tertiary markets that have limited competition have actually outperformed in this time, which is great to see. We have a combination, we pride ourselves in doing all self-storage asset sizes and classes in all markets. So we'll have the core deals for sale, we'll have the secondary deals for sale, and we'll have tertiary deals for sale. And we'll have also, institutional size, which is, depending on how people classify it. I mean, we are 40, 50, 60,000 north of that, or below, 30 to 35,000 is sub-institutional size. We'll see a lot of those assets kind of like in those markets, but people who are owning and operating these tertiary deals where they have limited competition have actually outperformed everyone else, because they don't have that oversupply issue. They're the only players in town. They not only have they seen their occupancy go up, they've also raised their rates. And they've been very strategic and shrewd by adding tenant insurance programs and maybe some type of admin fees or other things to like help the ancillary income of the deals. So depending on your market, depending on the municipalities, it's different. It's very specific. However, on a grand scale, big picture, what we're seeing nationally, we are seeing occupancy drop and we are seeing rates slashed across the board.
This is your day of sunshine with David. Yay. No. But that's why I do this, guys. It's like,
I hope it's not a doom and gloom type of thing, because it's not what I'm trying to communicate.
It's reality.
It's reality. It is reality.
That's why I do these things. I want to have reality checks with not just me talking about it, but people that are in the trenches on being owners and brokers, because you're seeing all of it.
Absolutely.
You know what's going on. So
yeah, and Jim, this is kind of like that's a great point you made there. Just to piggyback off that, this is a lot of what we tell our clients. This is what we tell owner operators all the time. Give us a call your broker, have a discussion with them and what they're seeing, because we not only specialize in selling self-storage properties, but we're talking to everybody. We're talking to vendors, we're talking to contractors, we're talking to developers, we're talking to lenders on a daily basis. We're talking to owner operators on a daily basis. So we're really on the front lines, because it's our job to talk to everybody and figure out, hey, what's construction pricing looking like? What's labor pricing looking like? What are material pricing looking like right now? What's land trading for? What do rates look like in this market? Is this market oversupplied? We're doing a lot of these analysis for our clients who have deals or land tied up in certain markets, or have closed on land in certain markets where they're saying, hey, is it worth us developing here? What does it look like? What are the optics? High level, would you develop a facility over here? Should we expand our facility? We have even like really good conversations. We have great clients where sometimes they're under contract on deals. They're saying, hey, based on the current market conditions, where would you guys price this deal at? Right now, are we overpaying for it? So we're having a lot of those conversations with our clients, just like more in the advisory capacity, seeing what they can do. And for buyers and people that are active out there in the market, it's definitely tough. And it's, I think brokers get a bad rap a lot of time and get misrepresented. We're representing our clients and we are always trying to sell deals for the highest and best price, always.
Sure.
However, there are deals out there in the market right now that are being brought out that are overpriced. And it's not overpriced because the broker wants to bring out an overpriced, unrealistic listing that's not going to sell. It's based on what their client is telling them that they want. With that being said, we're telling all of our buyers, hey guys, put in offers and let's see where it goes. Because a lot of the time, our clients are telling us, hey, this is our price, this is our bottom line. And we get an offer submitted, call it at 20 or 15% off the ask. And then all of a sudden they're negotiating and there's some wiggle room there. So we don't always know what the deal is going to trade at. We don't always know what the seller is willing to take on that deal. So call your brokers, call the listings, underwrite them, figure out if it's a good deal for you or not. But I would still encourage you to put in offers, even if it's going to be a lowball offer, still go ahead and put that offer in and see where it goes, because maybe it's going to be rejected, but they may come knocking in a month or 2 months from now and saying, hey, we're willing to play ball here. We've actually countered the offer. So we've seen that happen in a few instances as well, where some buyers have gotten great deals because they're willing to just offer very competitive terms. And just another thing, just to go off of that, for buyers, always ask if seller financing is available. We're seeing seller financing deals happen a lot more now than they were happening a year and a half ago. And the reason being is now sellers, depending on what their debt structure is on that current deal, or if they own it outright, they can offer more competitive rates or more competitive terms than a bank can right now, or a lender can. So if there's a deal where there's a scenario where the seller wants $2 million, if they're willing to hold the note, they may be able to offer a 5% interest rate, 3 years interest only or 5 years interest only, to get that number. Maybe based on what the lenders are offering, they may be only able to pay 1.5 million for that deal. So those are situations where deals are getting done, and I would always ask that. And for owners as well who are interested in selling the properties, there's a lot of benefits to doing seller financing. It limits your tax liability early on, so you don't get hit with that entire tax from the entire sale of the property. Also, it gives you an opportunity to sell your deal at a premium, versus like what you'd be subjected to now, which is lender financing terms, which are really aggressive and hovering around 7-8% right now. So
we can do a whole episode just on that, about seller financing. Maybe we will. We can do that in the future. Anyway, for the time here, we'll wrap things up here. But again, you're a wealth of information. I'm glad I met you and had you come on. Plug away where people want to get more information, get in touch with you, and maybe get some deals. How they reach out to you? Yeah,
absolutely. Feel free to reach out to me anytime, over the phone, or over text. My number is 914-365-0752. Also feel free to email me. My email is david.perlleshi, that's PERLLESHI @franklinst.com. So feel free to call me, text me, email me. This is what I do for a living, so it's never too early or too late. I'll almost respond immediately, always. So
perfect. And I'll put all that information, contact information in the show notes as well. So okay, well, this has been great, David. Thanks so much. We'll do it again, man.
Jim, I really appreciate your time. This has been great.
Right. Sounds good. Take care. Bye. Before we wrap up, just a quick reminder. Do you want to level up your storage game? Visit theselfstorageshow.com. Grab some high-value freebies, check out top vendor spotlights, and stay in the loop with our newsletter. Do you want to chat about becoming a client with 3 Mile Storage Management? All the info's there. Plus, if you've got a story to share, we're listening. Everything you need is at theselfstorageshow.com.